of your capital and your time. We all have limited time, we all have limited capital, and you have to spend both wisely. And it can be easy to waste both. You can have positions that are at a loss and you don't want to sell them because you don't want to take that loss. And oftentimes that is not the best use of that capital. It can be reused for something better. And same with the time part, right? There's a lot of information being thrown at us online, in life, and it's about focusing on what matters and eliminating the counterproductive habits that are very common. It's part of being a human, which is letting emotions influence our thought process. Chasing headlines and using them to justify your decision making. Now, there's an old saying, you can chase returns, but you'll never catch them. And I find that to be true over and over again. And you're starting to see that now after this recent run in the bigger cap tech stocks starting to reverse while other parts of the markets are starting to rally. So interesting little trend that I've been talking about for a couple of weeks and started to continue to emerge today. Now, my goal here is to give you my unbiased perspective, developed from over 20 years of investment experience, and help you take that next step in your journey. And that's what this is. Life is a journey. Life is but a journey. Life is but a series of steps until the end. And hopefully, before you get to the end, you get to a level of financial freedom that allows you to live comfortably, to live in a way that allows you to do things that you would like to do versus what you have to do. That's really what financial freedom is. So to that end, this podcast is your opportunity to submit your finance and investment questions that are relevant to your task, to your portfolio. So let's get started. I'm ready to tackle your questions. You have to call, though, and our InvestTalk phone line never closes. It's 888-989-CHART. Now, my focus point today looks in the story behind this question. Could the American banking system landscape be on the verge of a seismic shift? And we're going to look at some recent trends. We obviously had the banking crisis, the regional banking crisis in this early spring, and now we're into the summer. So, it's starting to look further and further in the rearview mirror, but that doesn't mean that the ramifications of that crisis, mini crisis, aren't yet to be felt, right? There's always downstream impacts, and we're going to talk about that. Also, I want to touch on the 5 main worries of investors after we've entered a new bull market. Equities are up 20% from their lows. Theoretically, technically, that's a new bull market, and there's the old saying, market climbs a wall of worry, and we're going to look at what those worries are. Also, when you're buying an ETF, we always say you need to understand what's in it. There are plenty of resources the fund family has to tell you what's in it. So you should be able to go and look at it. And it's pretty interesting to look under the hood of some of these ETFs, and you often aren't getting exactly what the name of the ETF is telling you you're getting. So we're going to look at some of that data. And then lastly, hospitals. Hospitals as an investment, they spent big on nursing and expanding their footprint during COVID, but many are closing unprofitable services. And I think this is a good window into a sector of the economy that a lot of people think that's a great investment because it's healthcare and healthcare is consistent. There's always people getting sick. And that couldn't be further from the truth in the fact that, just because you're getting a steady flow of patients doesn't mean you're always profitable. So we're going to look at that whole sector as a whole. All right, let's go to our first listener question. We're also going to touch on a few voice bank questions. One is on bond maturities, other is Welltower, and I have a perspective today on the history of investment banks. I really like this one, really kind of subsector of the market and something that most people don't understand a ton about, but I want to give some good history. I think that's very interesting. So all this is what we have planned today, but of course your live calls are most important at 888-99-CHART. And we're going to go to one now, and it's Daniel in Colorado looking at Archer Daniels Midland.
Hello.
Yes, how you doing?
Hi, yeah. I'd like your perspective on ADM. I know it pays a dividend. Just wondering if you think this is a good buying time.
Well, ADM has pulled back, and this is Archer Daniels Midland. For everyone else out there, what they do is they are a major processor of oilseeds, corn, wheat, other agricultural commodities. They're huge in the ag space. It owns an extensive network of logistical assets to store and transport crops around the world. It also runs a nutrition business and focuses on human and animal health, as well as a large producer of corn-based sweeteners, starches, and ethanol. So well-diversified, $42 billion market cap, and so it's definitely a large cap. Earnings supposed to fall 12% this year, 4% next year, and those estimates continue to come down. So that's my biggest worry. The earnings trends remain negative. The technicals, though, are starting to strengthen. You just crossed above the 100-day moving average, really for the first time since the first of the year, first couple trading days of the year. Yeah, the first trading day of the year. The first trading day of the year, it opened above the 100-day and closed below it, and it hasn't seen it since. So it opened the year right around $93 per share. It found a low right around $70 per share. Now we're at $78.54 at the close today. 2.3% dividend yield, like you said, but I always say the dividend is not about what it currently is yielding. It's about the growth of that and the sustainability of that dividend as well. And now their cash dividend pay ratio is 56%, which is fine. Not crazy high, not crazy low. I think the dividend is sustainable. They are earning above what they normally do. Longer term average is in the low teens for return on equity. This is at about 18% right now, kind of near an all-time high. So near an all-time high. The highest was in 2007. So it's a little bit over earning, and you're seeing that reversion to the mean now. But the technicals are once again improving. It did make a higher low recently, which I like that from the low in, the summer of last year? Yeah, summer of last year, where it was also right around $70 per share. It's a good business. It's a good company. Am I head over heels for it? No, because they are technically, for the most part, they are a price taker. Okay, they don't have a huge economic moat around their business, but it's a consistent business. It has consistent cash flow. They have not a ton of debt, which I like. I like companies that don't have a lot of debt right now. It's trading at reasonable valuations, and so I give this one a mild buy if you're trying to gain exposure to the soft commodity sector, right? Ag. And this is the biggest, baddest, most well-diversified, probably the best run within that space. So if you have no exposure there and you're looking to gain exposure, then this is probably the name for you. So that's Archer Daniels Midland. ADM is the symbol. Now we're going into a quick break. Please remember that you can call anytime and leave your question on the InvestTalk voice bank, or if you're listening via the live stream on AM 1220 in Silicon Valley, you can call now at 888-99-CHART.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward?
I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Food, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART. got finance and investment questions, and Justin Klein and Steve Peasley are ready with their unbiased answers. Don't forget to call InvestTalk, 888-99-CHART.
I called to ask about bond maturity. How do I know when a bond is at maturity? Is that based on when I purchase? Is there a date that is specified that I need to look into? I'd love to get some insight on that. Also, speaking of bonds, what do y'all think of bonds such as ticker symbol ANGL? It's an fallen angels bond. I'd love to get some insight on all that I just asked about. You guys rock. Keep it going. We all learn a lot from y'all, so keep your knowledge flowing, please. Thank you. Have a great day, y'all.
I appreciate the kind words. And the simple answer is yes. Every bond, there are some perpetual bonds that don't mature. Those are very rare. But for normal standard bonds, treasuries, corporate bonds, municipals, etc., they pretty much all have a maturity date. So you have to look at the QSIP number, look that up, and there should be a maturity date on there that you can observe. It's irrelevant when you bought the bond. That particular issue is going to mature on that particular date, unless obviously there's a bankruptcy of any kind, and then it never matures, and you don't get your par back, and you go into potentially receivership of whatever assets the courts tell you get as a bondholder. But yeah, every bond has a bond maturity pretty much that you have to look up. Now, ANGL is a bond fund, so it is not a bond. It holds bonds. 98% of its assets, 99.8% of its assets are in fixed income, 0.2% in cash. So basically all fixed income, all junk bonds. So yeah, pretty much all. So what's this? Trying to look at the stats here. We got credit rating. Yeah, all corporates. Okay. Yeah, all relatively short term too, between 3 and 5 years. A lot of double B, single B, below B. Basically, only 3 to 4% are investment grade. The rest are junk, and that's what this is. It's fallen angels, companies that have fallen out of the investment grade ranking, and they're mainly in this high double B range, so the high junk, which is good, right? You're not a ton of super low rated bonds because it is exponential, meaning those double B bonds, they have certainly a higher chance of going bankrupt typically than your triple B, your investment grade and higher, but it's not a whole lot higher, right, in risk. It's pretty minor. But then you start getting down into B, and that chance of bankruptcy can double, triple, right? And then you get into the C range, and now that gets exponential. So the fact that this doesn't have a ton of exposure below double B makes me think it's pretty decent, to be honest with you. So not a bad way to gain exposure to the high yield market. It does yield, let's see, what's the current yield? 7%-ish? No, sorry, 5%. 12-month yield, 5%. So, corporate bonds right now, you're not getting a ton of yield compared to what you're getting on treasuries, but you can find good opportunities. This one in particular, I probably wouldn't be buying it right now. Now we're heading into a break. Steve and I are happy to play your recorded voice bank questions, but we love taking your live calls as well, and our number never changes, and it never closes on InvestTalk, 888-99-CHART.
Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
Now, my focus point today looks in the story behind this question. Could the American banking landscape be on the verge of a seismic shift? And we all remember not long ago, well, I guess that's subjective, but to me it's not long ago, and we had the regional banking crisis in, end of April timeframe, and that was all because of rising rates, and it started to squeeze a lot of the way that banks made money. And mainly those smaller banks who had had a more flighty deposit base. And Silicon Valley Bank obviously was the poster child of that. Now, the country has 4,672 banks. And it looks like, either by force or by regulators, market forces or regulators, that there will be consolidation within the space. And this shouldn't shock anybody because we have the most banks in the world by far. In fact, the US has more commercial banks than all the other G7 countries combined. Think about that. UK has 311 banks, Germany has 251, France has 228, Italy 218, Japan 112, Canada 81. We have 4,839 banks. It's a lot. Now, let's back up and, how did we get here? Well, the first is obviously post-financial crisis, there was a lot more regulation on these banks, especially the large ones. And it forced the large banks to diversify their business, to get out of certain risky business, to have larger capital buffers. And the smaller banks were kind of viewed as lesser than, saying they're not systematically important. And so they were viewed as able to kind of skirt by with less oversight. And many investors thought them as safer. They were less complex than the giant banks, so easy to understand. And obviously, they were not, in hindsight, less risky. In many ways, they were more risky. Now, for over a decade post-financial crisis, banks were awash with deposits. There was a ton of excess reserves, what I call excess reserves within the banking system. And a lot of what the Fed did doing QE and we had the TARP program and all that, that was to recapitalize banks, to get them into a healthier position, and then kind of put handcuffs on them and force them to stay that way. But once again, that was the bigger banks. Now, so far this year, the regional banking index is down more than 20%. Larger banks like JP Morgan, up 7.6% this year. And what you're starting to see is these banks, all banks, are being forced to pay higher rates on their deposits because people are taking that money, they're putting in treasuries, things that are yielding a lot more than your savings account. And this is really breaking the business model of many of these especially smaller banks. And then on top of that, you have the oversight that these banks are going to get because of this. That's going to tighten their ability to maneuver and makes them less profitable overall. All of those things, right? More oversight, higher cost of deposits. And so scale is going to become more important. Scale is important in almost any business, but it's equally as important in the banking sector. So the incentives for the smaller banks to sell to the bigger banks has become a lot higher. So they either need to raise capital or you've got to sell yourself. Or you could wait it out and hope that interest rates fall, which obviously they haven't over the past couple of weeks, and a lot of those assets just roll off the balance sheet. But a lot of them are long duration that could take a decade. Some of them are 10-year bonds. And then in the meantime, you risk that something else goes wrong, like default cycles rising. And a lot of those smaller banks, they have a lot of exposure to commercial real estate. We know what's happening in office. And there's a lot of refinancing coming up over the next 2 to 5 years, and that's going to put strain. And a lot of them are already trying to sell as much assets that are longer duration at reasonable prices. And it's very hard for them to raise capital, raising equity. That's one option typically, but not in this case because people are pretty worried about that sector as a whole. And then there could be, and it could not even be them that causes them to be pushed into another precarious situation. Just look at the contagion that happened in the spring with Silicon Valley Bank and that spread to bank to bank to bank. All you have to see with another earnings cycle is a few of these banks seeing big flights of deposits again, losing 20, 30% of their deposits. And so these bigger banks, yes, they have to adhere to more regulation, but they are more able to do that because they have giant regulatory teams already. They can cater to consumer technology demands, all of that. And so we're at the start of this large consolidation period between these smaller banks. And I actually don't think that's necessarily a bad thing. These other large G7 countries have gone a long time with only a few hundred banks, and that's probably more appropriate anyway. Now, on the next Invest Talk, we'll look into this question. Is it good news for investors if rates stay higher for longer? With the Fed believed to be readying another rate hike, bonds offer attractive yields even after inflation. So we're going to look at that tomorrow. But for now, I'm Justin Klein, ready to take your question live at 888-99-CHART.
No two portfolios are alike, and every investor has a unique set of circumstances. So don't forget to call InvestTalk. 888-99-CHART.
Hi, my name is Brayton. I was just calling. Thank you guys for the show. It's a good, amazing job. I just had a question about a stock. It's called Welltower, Welltower, and the ticker is WELL. I know it's a REIT. I was just wondering if it's a LLP or a LLC, or if you get a K1 for it. This is for the answer to the show. Thank you.
K1 is a REIT, so that's the nice part about REITs is you don't get that K1, but it is a pass-through entity, which means that the dividends that you're getting, the current dividend yield on Welltower, is 3.1%. So that 3.1% is taxed at your ordinary income tax rate if it's in a taxable account. So understand that these tend to be better be held in some sort of IRA, 401k, Roth IRA, etc. But Welltower, it's a solid, very large, $39 billion market cap healthcare REIT. It has 1,900 in-place properties across senior housing, medical office, and skilled nursing facilities. It has 100 properties in Canada and the UK, so a bit of global diversity there. And it's certainly one of the best run healthcare REITs out there. But that's also why the yield is so meager, because it is so well run. This is one of those things where a lot of people take to chase yield and usually burns them. And this is lower yield, better run, solid REITs if you're getting into the healthcare sector. I still don't love the healthcare sector. The typical profitability within that sector is pretty meager on the REIT side. But if you're going to buy one, this is probably the one you want to buy. All right, let's go to James in New York. He wants to talk about OGN, which is, what's OGN? I'm pulling it up. Organon. There you go. Organon. Do you own it or looking to buy it?
I've had it on my watch list for some time, and I want to know if it is possibly a value trap, or is it something that might turn around from the losses that it's endured. So I don't know if the fundamentals are strong enough, or is it a good value to add at any point in time?
Well, it does look like a good value. I will say that. It does look cheap because you're looking at $4 in earnings going forward, and it's $20 stock, so 5 times forward-looking earnings. The issue, though, here is the debt level that they have. And this is a spin-off, and we've looked at this in the past. This is a spin-off, I forget the company that was a spin-off from, but it is a spin-off, and it took a bunch of debt on. And so right now its market cap is about $5 billion, but it has about nearly $9 billion in long-term debt on its balance sheet. And what kind of worries us when we've looked at this is that they haven't really been able to pay that down very much. In the summer of 2021, so 2 years ago, it had $9.3 billion in debt. Now it has 8.7, so it's paid off about $600 million of that, but its free cash flow is about $430 million. So I worry a bit about how long it's going to take them to really pay off that debt. Now they're paying a lot of it out in dividend, right? 5.5% dividend yield. So that's why a lot of people are attracted to this is, hey, they're paying a 5.5% dividend. It's only 5 times forward-looking earnings. So it looks super cheap, but their business isn't growing. The last 4 quarters revenue growth is averaged about negative 3-4%. And earnings the last 4 quarters are in decline. They made $12.71 in 2019 and $4.22 next year. So this is kind of a melting ice cube. It's a very slow melting ice cube, but it's a slow melting ice cube with a lot of debt. If this didn't have any debt on its balance sheet, I think it's cheap because it's not really a slow melting, and its cash flow compared to its market cap is reasonable. But that debt overhang is what kind of says, I wouldn't want to own this. So and then the trend, it continues in a downtrend, and I wouldn't want to get in front of it. So I'm passing on, what is it? Organon. There you go. Thanks for the call. Now, my perspective today looks in the history of investment banking in the United States. Now, first off, let's talk about investment banking versus commercial banking, which is what our main focus point was about. The banking crisis recently was about. That was about commercial banking. Now, investment banking is usually when a bank pertains to offering financial and strategic advisory services to clients. Things like M&A, capital raising, whether that's issuing bonds or issuing equity, some sort of capital markets underwriting. And the role of an investment banker is to be an intermediary between the clients and the corporations. So it's to ensure that there's the right guidance that is delivered based on the company's expertise, past transactions, the current market, right? You want to go public. Okay, here is the price I would price it at so that you will sell all of it quickly, easily. You want to buy another company. Okay, here's the advice on how much I would pay. And then there's some negotiation between, the investment bank, the company, and the target company, right? So that's the investment banker's role. Okay, and these are complex matters. There's a lot of regulation, especially when it comes to public market issuance of stock or bonds. And there's obviously regulatory issues with M&A, potential monopoly problems, or competitive steps that need to be taken to make sure that the regulators are happy with the transaction. Okay, so that's what an investment banker's job is. Now, with that being said, let's go back in history, and I'll give you a broad outline of investment banking throughout the many decades. Now, Philadelphia financier Jay Cooke established the first modern investment bank during the Civil War era, and private banks had been providing investment banking functions since the beginning of the 19th century, and many of these evolved into investment banks post-Civil War, called postbellum. I don't know if you knew this. Doing the research, postbellum is after the Civil War. Antebellum is before the Civil War. I didn't even know that. I've heard of antebellum. I never heard of postbellum. Anyway, so we'll jump ahead. Now, 1896 to 1929, prior to the Great Depression, you had J.P. Morgan and National City Bank were really the investment bank leaders. And they sustained the financial system. J.P. Morgan, the man J.P. Morgan, personally was credited with saving the country from huge panic of 1907. But in 1929, the investment bank's speculation was out of control. And they used Federal Reserve loans to bolster the market. And this resulted in, obviously, as we know, the market crashed in 1929, sparking the Great Depression. Now, during the Great Depression, the nation's banking system suffered dramatically. 40% of banks either failed or were forced to merge. And this brought on the Glass-Steagall Act of 1933, which basically separated commercial and investment banking. Now, they've since repealed that. That was in the 90s, right? You had the boom of the dot-com bubble. In 1999, you had 584 IPOs that were done. That was the most ever in a single year. And most of them were in the internet sector. Obviously, the investment banks helped with that. Now, there was, let's see, in the 80s, however, there was a rise of a lot of financial products like derivatives, options, high yield and structured products, high yield bonds. High yield bonds weren't really a thing until the 80s. Michael Milken. And this brought even more fees to investment banks who got buyers for these type of products. Right? We're able to pitch them to the market. So that's really where I think investment banks, they were in the doldrums post 1929. But they reasserted themselves in the 80s and obviously up until 2008 when you had just the big five investment banks mainly. Bear Stearns, Goldman Sachs, Lehman Brothers, Merrill Lynch, and Morgan Stanley. And as you know, only two of those survived, Goldman Sachs and Morgan Stanley. Bear Stearns gobbled up by JP Morgan. Merrill Lynch gobbled up by Bank of America. And Lehman Brothers obviously went bankrupt. Now, according to the Financial Crisis Inquiry Commission report, the executives of the country's five major investment banks kept such small cushions of capital at their bank that they were extremely vulnerable to losses, right? Took way too much risk. And I still think to this day, you probably want Glass-Steagall reimposed. But it hasn't. Who knows why? It may come to an issue again down the line. But regulators, they're always focused on the last war, and I think that's still the last war. Now, many decades from now, they'll probably take their eyes off the ball again because there'll be another war that they're focused on, and they'll say we've gone long enough, and there'll be enough lobbying to reduce the regulations. But as of now, I think they're fairly safe. But they are going to be very cyclical, at least the investment banks, the Morgan Stanleys, Goldmans, based on what's happening within the capital markets environment, right? Are IPOs going off? Are bonds being issued? Is M&A happening? Those are the main ways that they make money. Now let's grab another question at 888-99-chart.
Good afternoon, Steve and Justin. This is Steve from Colorado. And the stocks I am interested in is I have long-term positions in Bristol Myers Squibb as well as Novo Nordisk, so BMY and NVO. I'm interested in consolidating the number of stocks that I own, and I'd like to reduce the number that I own. I'd like your opinion on selling my position in BMY and increasing my position in NVO. I like both stocks, but NVO just seems to be outperforming BMI considerably, but my fear is that NVO may be overpriced at this point. I'd just like your opinion. Thank you.
All right, I like that you're looking to consolidate. That's a smart move. Now, Bristol Myers Squibb. Let me take a look here. Bristol Myers, it has certainly been underperforming. Revenues down the last 3 quarters. Earnings are roughly flat, but that's why it's trading at 8 times forward-looking earnings. 3.6% dividend yield. Take a look here. I have to look at their patent cliffs. They don't have a ton of debt, so that doesn't worry me. But why is their business so slow? That would be my main question. Yeah, it looks like they have patent loss pressure. It's buying Celgene, or it bought Celgene to improve its pipeline. I'd have to dig into this. That's really what the issue here is. Worries about the pipeline of Bristol Myers. And when it comes to Novo Nordisk, that's doing much, much better. $353 billion market cap. Revenues are up 24% last quarter. Earnings up 47%. But you're right, trading at 40 plus forward-looking earnings. And I do think it's overvalued. So here's my thing. I don't like either of these names. I mean, I like if Novo Nordisk was trading at the same multiples that Bristol Myers was, then yeah, I would probably like it, but it's not. It's trading at drastically over price levels. Price sales ratio 13 times. I mean, that's just egregious. And yeah, they don't have any debt. That's positive. But if you look at their multiples, they're just way, way, way overpriced. So here's my advice. I'd be selling both. I think I would be selling both of them. I don't like the patent issues of Bristol Myers, and I don't like the valuation of Novo Nordisk. I'd be looking for others within the space that have reasonable growth. They don't have the patent issues of Bristol Myers and aren't trading at egregious prices like Novo Nordisk. So probably an answer you weren't expecting, but that's my answer. I would sell both of them. Thanks for the call. Now, I don't know if you know this, but we've entered a bull market. But just like we have been for the past 15 years or so post-financial crisis, investors are still looking over their shoulders. And even professionals say that they don't feel the rally is sustainable. But history shows that investors don't tend to love bull markets when they're in them. They only love them at the very end when all the money's in, right? That proverbial wall of worry. So let's talk about what the wall of worry is right now and how much each one has credence, okay? First is earnings season. Earnings season kicks off this week, actually, and companies in the S&P are expected to report a 7.2% decline in earnings for the second quarter. Now, that would be the third consecutive quarter of year-over-year earnings decline. But last quarter was low single digits. Right now, they're expecting mid to high single digits for this quarter. And overall profit margins are expected to fall to about 3.4%. That's down slightly from last quarter. But, the high was 13%, and this is still reasonable profit margins, okay? So I think I don't see this as a big worry because it's a very modest decline, and it's coming off very, very high levels of profits. Now, what I think is most worrying is that will companies still be able to maintain those profit margins even though inflation is ebbing? A big reason for them having such strong profit margins and maintaining them at above average long-term levels was it was easy to justify based on quote-unquote inflation. Are they still able to do that? Will be a big question that we'll find out after earnings season. But I'm going to get to the rest right after the break. So if you're going to call, you want to do that right now at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Now, before the break, I touched on the wall of worry that the market kind of continues to climb, and really the 5 things most people focus on when they're trying to argue bearishly about the market, right? So the number one was earnings season, 7.2% expected decline in earnings. Still, my answer to this one is TBD. We'll see if this comes in worse than expected, better than expected, what type of trends we see with earnings overall. But if it does come in at least reasonably in line, I don't see it as a big worry because you're coming off very high levels of profitability. It's not like we're going into some major decline in earnings. It's more of a reversion to the mean. Now, number 2 is the yield curve inversion, and this is all about the 2-10 spread. I like to look more like the 3-month 10-year spread. I think that's a much better gauge. But, this hit the widest negative gap since 1981, and people are pointing, oh, this is a recession signal, or this is a recession signal. And you're right, it is a recession signal to a degree, but that could be many months out. And typically the market doesn't react until it's pretty obvious that we're going into one. Okay, so remember, this is the 2-10 year. So it's saying that the weakness in the economy is going to be even beyond, the major weakness in the economy is going beyond 2 years, okay? So this is another one I don't really worry about near term. You keep an eye on it. What you actually have to worry about is when this starts to no longer become inverted. That's when you're in the recession. That's when things are bad. So as long as it stays inverted like this and doesn't go the other way in a big way, then I'm not too worried about it, okay? Now, number 3, global markets struggling a bit. You had a lot of optimism around China and Europe really recovering in the first half of the year, and that didn't really materialize. Eurozone slid into a recession. China grew, but not that much, not nearly as much as expected. And so this is a bit of a worry to me because I do think that the global economy needs to stay intact for you to have, these multinational companies do well. So this is probably the one that was least talked about, probably has the biggest worry on this list. Number 4, higher rates causing more trouble. This is the banking crisis that we talked about. But once again, this is really domiciled in small pockets of the market and really doesn't worry me too much. I don't think this is a huge contagion event that's going to take down the financial system. You had your test in the spring, and obviously the Fed kind of push that back. And then lastly, stock positioning does look a bit stretched, but it's more stretched and overcrowded in those big megatech cap names after this recent rally. And that's probably the biggest risk is that positioning reversing. Now I think you can squeeze one more InvestTalk caller question now from 888-99 chart.
Hi, Steve and Justin. Thanks for the great show. I would like your opinion on Markel, MKL, Mary, King, Larry. I'm looking to buy and hold it for 5 to 10 years. Thank you. Bye.
All right, this is Markel Group. This offers specialty insurance products and programs for niche markets, typically very profitable. And I think this is a very good company to own. And this is one of those great lessons. The current price that it's trading for is $1,370. And people will say, look how expensive it is. It's $1,370 per share. Yeah, well, if you look at it based on its earnings and its cash flow, it's pretty cheap. My free cash flow about $2.4 billion on an $18 billion market cap. Minimal long-term debt on its balance sheet. A lot of cash. I'm fine with this. I'm fine in buying and holding a company that operates in a niche market, right? Not a whole lot of competition. Solid return on equity, high single digits, low teens, longer term. I think that's fine. Its business is obviously up and down, but over the long term, it tends to perform well. So I'm fine with Markel. Well, I'm Justin Klein. This completes another InvestTalk program. Steve Peasley and I thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you'll find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And we have now achieved 53.8 million downloads since it all began. Thanks to you. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual